You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. Private lenders, let me tell you about the most reliable and robust software to service and originate your loans. The Mortgage Office is used by the most reputable and experienced private lenders across the country and abroad. It has been the industry leader in loan management software for over 40 years. Recently, they launched a fully web-based origination platform, and they'll soon be launching a fully web-based servicing platform as well. The Mortgage Office is also SOC 2 compliant to make sure you and your customers' data is safe. Recently, they've launched the ARM module. It's second to none. It automatically ties to indexes, support ceilings, floors, initial and periodic rate caps, carryovers, and negative amortization. TMO's revolutionary approach to lending software changed the industry forever, and they continue to be the cutting-edge technology provider in their trusted development. Enhance your communication, provide transparency, and automate your back office today with the Mortgage Office, the ultimate lending software. Hey guys, Kevin Kim coming to you via Zoom once again for another episode of Lender Lounge with yours truly, Kevin Kim. Today, we have a very special guest, Jennifer McGuinness, President and founder of Invigorate Finance, right? Invigorate Finance?
Correct.
All right. So, Jennifer, please introduce yourself to our audience and let's get started.
Hi, everybody. I'm Jen McGuinness. For those of you that don't know me, as you know, Kevin alluded, I run Invigorate Finance. We are a aggregator, so a sexy way of saying we enter into contractual relationships with lenders to originate loans to our specifications. We go through diligence and we purchase those loans. We specialize in the non-QM, QM relevant, and business purpose spaces. So we're diversified, and we have both delegated and non-delegated channels. I think that, you'll find through this conversation some interesting things to learn about Invigorate.
I think it's really interesting because it's the first time on the show we've had an organization that does both. Kind of consumer. We separated here at Jurassic about consumer purpose and business purpose, right, on the resi world. And I think it's really awesome to hear about that. Anthony and I were talking about this and looking back, I think it was about 6 years ago, wondering where the consumer shops were in our space. And why hasn't it kind of become more of a thing? And, looking at preparing for this interview and looking at kind of the client list and business list of folks who do both, very, very few who brought an institutional caliber. We've got a lot of originators who do both, but from a kind of capital provider, aggregator, national lender type of approach, type of perspective, not a lot of folks have taken that on. It's an additional burden. And my first question to you is going to be like, what were you considering when you crafted that mandate to do both? Because it's very rare.
So I have spent my entire career focused on more than one sector. So back when I started in the business about 27 years ago, I actually started on the happy side of origination, originating mortgage loans, right? And we did, mostly consumer-facing products, but we also did small balance commercial and other types of lending as well, right? And as I've gone through, the differentiated aspects of my career, I've really tried to stay diversified. So, for example, I first started in origination, then I went into legal, and I did the not-so-happy side of origination, foreclosures, bankruptcies, REOs, a vast array of complex litigation, right? Then I decided to take on the next challenge. It was build and run a non-performing, sub-performing acquisitions and servicing business, right? So did the workout side of loans, right? Then we sold that business. Then I went to the buy and the sell side on the investment banking side. So I was a co-head of asset management at Deutsche Bank, for example, and also ran breach of rep and warrant. So did happy and not so happy all at the same time. Then went into the hedge fund space, then the REIT world. And, in the REIT world, we designed the single family rental DSCR, business purpose loan programs. It first started, as larger term portfolio loans.
Mm-hmm.
Then everybody realized, 80% of the market only has 10 or less properties, right? So we needed a solution to be able to service the majority of the market, hence bridge and fix and flip, and the debt service coverage ratio of 30-year was born, right? Then we, turboed that by adding ground up construction in the business purpose space. On the resi side of things, when things got really locked up into an agency only world during the housing crisis, and then again during COVID, et cetera, we've really lived through an ebb and flow of agency, but through that entire cycle, my focus has been keeping private capital in the market,
Mm-hmm.
not becoming beholden to a agency model, and then bringing creative solutions and lending programs to market that really are a natural hedge to each other.
Mm-hmm.
So at the end of the day, I'm an investor, right?
Mm-hmm.
But one that's basically built and run the life cycle of these types of programs.
Mm-hmm.
And by virtue of doing that, you really can add competitive advantages for both consumer facing and truly business purpose loans. I wouldn't suggest doing it if you can't, accomplish that natural hedge to each other.
Right. But from an operational, a lot of folks would concur from a business perspective, they are definitely nice hedges, and they provide some nice diversification to the business model and allows them to kind of pivot as they progress. And one area tends to be less, a stronger performer than the others. It's nice to have both. But from an operational standpoint, it can be quite burdensome. The compliance burdens after 2012 for consumer shop just, skyrocketed, comparatively speaking, to our industry. When I say our industry, the private lending industry, which is business purpose, the vast majority of people are exempt. And so, and that was one of the reasons why one of our clients chose not to do it anymore. And so, how did you guys, as you guys started up, give us a little bit of history on Invigorate. When did you guys get started?
So Invigorate is a new formation company of a business that was already pre-existing.
Mm-hmm.
So the business actually launched in 2018 as Mortgage Venture Partners, right?
Okay.
So the business has been around longer than just the Invigorate entity. When we brought it under the Fay umbrella, we did launch it as a new co to just bifurcate, the historical business from the new business.
Mm-hmm.
But I do, Kevin, want to just address one thing you said. A lot of guys choose not to do it because they build the business as a trade,
Mm-hmm.
and it's not actually a business. So
Mm-hmm.
in many of my prior roles, we did the same thing. You'd raise hedge fund capital, for example, you'd have a 5-year duration. You were building a trade and not a business. A lot of, the components of the business were outsourced to your TPR firms and other types of fulfillment entities, right? You really can only do it well post-2012, increased regulation, et cetera, if you have a true business platform.
Mm-hmm.
So, for example, Invigorate has an internal credit team, right? In order to be able to securitize our loans, we have to go through the rating agency third-party review.
Right.
But we don't, for example, in our non-Dell channel, outsource our pre-close reviews to a third-party vendor to make our risk-based decisions, right? That all goes through in-house staffing. And that's one of the bigger components to being able to manage that diversified risk
Mm-hmm.
and also, take on that enhanced compliance
Mm-hmm.
to be able to do both businesses.
Mm-hmm.
When you're only building a 3 to 5 year wind down strategy, it's not something that you could accomplish well, in my opinion.
Right. That makes actually a lot of sense. We see some similar, I guess, philosophies or schools of thought in other clients. Some of them have, they maintain the commercial side of the business to have that diversification. Others have adopted the consumer bridge. We call it the consumer bridge product. And some have, maintained the diversification into the I guess you call it the non-QM sector. But it's funny because that for our listeners, we always get into this debate about non-QM. What does non-QM really mean, right? Because it can encapsulate what we call private lending. And my understanding is on that side of the industry, they view that asset class as non-QM in a lot of ways. And I'd like to hear more about your preparation in transitioning into this diversified model, because it takes a lot to establish the framework necessary to do both, but at a national scale like you guys are. So give me an idea of what was the preparation process like for yourself, and how did the transition with Fay and all that add more horsepower to the operation?
So when I originally started this business, right, I started first with residential products in 2018, and I never really plugged in the standalone business purpose or private lender. I did a lot of DSCR products, bridge, fix and flip, et cetera, but did it in concert with the resi player, right? In some ways, I think we left a lot of money on the table by not plugging in the private lenders initially back then. When we brought up Invigorate, I actually did the exact opposite of what I did initially in 2018. I first focused on plugging in the private lenders, the standalone lenders, et cetera, and then brought back the resi lenders. And the reason for that is because of the segue of getting the compliance right on this stuff. And to your earlier point, there's a lot less compliance, regulation, et cetera, that takes place on the true business purpose side. I do want to address one thing that you said. Business purpose private lending is not non-QM. I understand that you can, in fact, securitize them together, and many people do. But it's really the actual way in which you're speaking to a lender base. If you're talking to a residential mortgage origination business that's generally consumer facing, you have to talk to them about the product like it is non-QM, because it's non-agency.
Right.
Okay. But so that's the nuance, right? Everything today that's non-agency, people generically talk about as non-QM, unless it's QM compliant, right? Is it correct to do it? No, not necessarily, but it depends on your audience. It's really business purpose loans, right? Private lending is business purpose loans.
Right. And that's the differentiation we've made here internally. But it's always, we've had a few clients transition to it. One up in LA, and they whenever I have a phone call with them, they always joke about it, like, no, we do non-QM, but fix and flip is non-QM. Like, this is, you're talking to the wrong audience here, brother. So you explained it perfectly. Well, who's your audience, right? That's important.
Right. I mean, look, if you're pitching a bond to an investor and you have non-QM consumer-facing mortgages in it and DSCR loans,
right,
they're going to generally look at it as non-QM.
Right.
If you're doing a standalone DSCR securitization, it's business purpose loans.
Right. And so I like to kind of ask more about you and your background. You kind of hinted on your professional background a bit, but I'd really like to kind of hear how you came through the industry. You said you started in mortgage origination. Was it on the conventional side?
Yeah. So, it's funny. My entire career, I like to joke, is by accident, right? So I originally was a professionally trained opera singer who took a job at JP Morgan on the M&A side, right? While I was in the music conservatory, right?
What?
And then I accidentally ended up on my career trajectory, right? I actually was an executive assistant initially for JP Morgan, and then I looked at some reporting and I saw math glitches. I said, these numbers don't foot. The boss that I was working with, I had a great relationship with her, so I asked her, why don't these foot? They don't make sense to me. Well, back then, because I am that old, the stuff was still printed out in paper. And I said to her, it doesn't make sense. She looked at it and she said, it doesn't. We found $5 million, literally by me asking questions. Needless to say, I was moved to the analyst team, became an analyst on her team, and that's how I initially started my career. But instead of staying in music school, I decided to go back to get a regular degree because, quite frankly, at the time I was in an investment bank, and without that degree, I wasn't going to go anywhere above an analyst level or maybe a first stage VP.
Right.
So I actually quit that job, went back to regular college, and started working in retail origination on consumer-facing mortgages. I was literally an underwriter and processor when I segued out of that initial role while in school. I worked 3 jobs to put myself through college. Okay, the goal was actually pre-law, so I was on the track to actually become a lawyer.
Okay.
I wanted to be an M&A lawyer, right? And then I realized that the business people are the ones that actually do the part of the job that I like more. And
Right.
don't be offended, Kevin, but the lawyers are the ones writing up the documentation and doing less of the business side related negotiation.
Oh, yeah.
Long story short, I got into law school 3 times, never went. I did get a paralegal degree, worked as a paralegal, and have worked with lawyers my entire career. But I've accidentally ended up with the job role that I wanted. So anyway, I got my paralegal certificate, started working in law firms, ended up managing the national footprint of law firms for basically defaults, right? And complex-based litigation in concert with partners. And then I was poached by a client, right, to actually come on and help them build that servicing and acquisitions business that I mentioned, right? So that's actually how my career began. And I love to kind of talk about it as a happy accident.
But I hear a lot of interesting tidbits there. One thing I heard was you had an employer very early on. You had an employer that, I mean, I don't know about how things were at JPM, but like, and in a lot of major corporate America kind of took a risk because she saw something in you, right? That saw more talent than what I guess her the actual people doing the real work, and took a chance and gave you an opportunity. And I think that kind of stuff is important to talk about on these shows. Is like the importance of those kind of relationships. And you kind of hinted at it. You had a very strong relationship with that person, and she gave you the opportunity to go up and be an analyst. Like, in some parts of corporate America, they would go, okay, that's cool, moving on, and there's no empowerment there, right?
Yeah, but the other thing is, I'm going to tell you how I actually got the opportunity to first interview for that executive assistant job, right? Yeah. So again, I was in music school. I actually I took on a temp job on a locked floor. I was literally at the front desk. The person that I ended up working with literally was walking up to the door, holding a box full of things. And I had the common decency to get up and open the door for her. Okay? Doesn't happen as often as you think anymore. Right. But something like common courtesy can actually start a conversation that can bring you forward in your life and maybe even change the trajectory of what you're doing.
Right.
I literally got the opportunity to interview with her just because I had decency and courtesy.
Right.
And I think that's sometimes lost today. So I think, I think that's an interesting feature to throw into the conversation as well.
Oh, it's so important, and I always, one of the things that we talked about earlier on in the show in the first season was talking about the importance of networking and asking, right? But also, and asking for help, but also what you're saying is kind of thematically to me is so important, is having that little bit of kindness, that little bit of decency and courtesy rings true, and it goes a long way. And I still remember any random, sweet gesture that someone's done for me over my career. I try to extend the same to them. And what's kind of cool about what I'm hearing is like that has extended throughout, right? You had an opportunity to work now at the largest bank in the country as an analyst. And then I heard something else that was kind of interesting. But you realized the path forward you needed to have an advanced degree. You went to college, you did the whole legal field thing. And what was also really interesting is you were able to work in the default world, in the litigation side. So the client that brought you on, you must have built a relationship with that person. And was it another instance of kind of that personal relationship beyond business? What was the reason why that person brought you into the mortgage world?
So I think they knew that I had pre-existing mortgage expertise that was coupled with legal, because generally I was the one to always solve for how could we expedite the foreclosure.
Right.
And I think by virtue of being able to do that, we added significant value to the book of business for that particular client, right? So we blended business execution with legal, even though I was working in a law firm.
Right.
And I think that was really what started to develop that client base. And instead of asking the client to make the decision, we were suggesting what they should do. right?
Mm-hmm.
And once you start, collaborating, I think that's really how you build those relationships in order to get additional opportunity.
Mm-hmm. Mm-hmm. So let's talk about, so you go into the mortgage world, you go in-house effectively, right? Tell us from there, what happens next? Where do you go from there?
So I go in-house, and then I end up managing like everything that can go wrong with loans, from special situations, loss net to REO liquidation, breach of rep and warrant, document control. I was the escalation for acquisitions, right?
Mm-hmm.
And you really, it takes a lot of knowledge and expertise, but honestly, it also takes a ton of common sense.
Mm-hmm.
And I think that people discount common sense a little bit too much, right? So you have to be able to put the parts together. But one of the things that I've loved about my career and those particular aspects, and even today, is it's got a little bit of an ode to Sherlock Holmes, right?
Mm-hmm. Mm-hmm.
What is it that we're looking to solve for? How can we get there, and how can we expedite the outcome, right? And I think that goes hand in hand earlier stages in my career, but it also was really a foundation that allowed for me to accomplish other things that happened later.
Mm-hmm.
So, for example, in one of my roles, we were the first hedge fund to ever issue residential mortgage-backed securities collateralized by newly originated mortgage loans, right? Many guys had tried before us, right? But they didn't do it. And usually the reason they didn't do it was because their lawyers would actually quote the tax code says blah, 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 and they would just take their word for it. The reason, candidly, that we got it done is I actually opened the citation that was sent to me and read the code, right?
Mm-hmm.
Then I went back to my lawyers and I said, where does it say I can't? We have to build a structure, right? But we needed to have a creative solution, and you needed to be able to take the time to put the work in to take it to that next step on your own. And I think the beginning baselines of my career, working in the law firms, looking at these types of differentiations, plus having the lending experience, really gave me the catalyst to be able to do that. Whereas in a lot of people in our industry are very single siloed, I've really had the opportunity to build and run the full life cycle, from origination all the way through securitization, liquidation, and default. And I think that is really why, you're able to get those enhanced opportunities or maybe accomplish some of those tasks that may not have been done before. Now, a lot of hedge funds have done it after us, right? But it had to take that first person to get it done.
Right.
And then, the strategy gets cloned. You know how this works.
Yeah. Okay. Well, I mean, that's kind of interesting because there's so much diversity in that kind of career path, right? There's hedge fund, there's securitization, but there's also, what I basically call default services, right? And fighting in the trenches on the bad loans, and there's so much diversity of experience, and I like to kind of pry into the default side a little bit more because we don't talk enough about I guess default or foreclosure enough on this show, and I think it's a product of frothy times and healthy times the past 2 years since the show's been running. But I always like to ask the people who've been doing who have experience with that is, what are some of the things that are really just so simple but always just missed, overlooked, right? You are describing things as what I heard was a pragmatist approach, right? You're asking questions and trying to find solutions, not necessarily get hung up on the this is how you do things kind of approach. But what I want to hear about is kind of how has that been exercised in the world of default services and special situations and REO and foreclosure? Because a lot of people they don't know what to do in that situation. A lot of lenders even. So
so one of the key features of my career, even when I was in the investment banks, like when I was at Deutsche Bank, for example, I was also handling the asset management and servicing not only certain credit aspects of buying loans, right?
Mm-hmm.
And I think that you need to get ahead of the things that work against you when you're dealing with defaulted loans. First and foremost, you have to make sure that your servicer, in fact, is, not advancing when they shouldn't be. So, for example, no forced placed insurance when you have insurance in place, right? So you have to make sure that the setups are correct on the loans. And new loan origination versus non-performing loan is very different in servicing setup, right? So I think that's very nuanced. And believe it or not, there's not a lot of, aggregators or lenders that are good at selecting a servicer that knows the difference, right? So that's an important feature. In addition, how can you get around the roadblocks of foreclosure? So for example, it generally takes 3 years to foreclose in Brooklyn, right? Well, that's Brooklyn, it's Kings County, everything there is slow. Well, how can you expedite that process? It's also one of the areas that's most known for borrowers attempting to dispute foreclosures. Well, if they dispute a foreclosure in New York, you can move to summary judgment. All of a sudden, you've got, a 12-month or less foreclosure, right? So my point is knowing the nuances of how to direct your law firm and making sure that your law firm is, in fact, reacting, right? If you have legal description issues, if you have title issues, many of those can be dealt with in, secondary causes of action and foreclosures. A lot of servicers and also investors wait for title claims to be dealt with and taken on by the title company. The reality is, if it's a valid claim, the title company is going to pay for it anyway. Right. So you might as well get the expediter by adding, the components to the legal actions up front. But you also have to have, the expertise to do that. Legal description issues, prior open mortgages, stuff like that. You can absolutely handle those things in a foreclosure and move your ball forward while waiting for all the other checkboxes to be checked. So you got to move in a dual tracking way and really have an asset management component. So for example, on our portfolio at Invigorate, we are always the asset manager on our loans, whether it's a joint venture, our own book, et cetera. We oversee the portfolio of loans with the servicers.
Well, that's important. And I like the mentality of because I'm hearing a lot of different things at once, but the key fundamental component is a very pragmatic, solutions oriented mentality, and a lot of attorneys forget about that. I think because they're afraid to get sued, but also sponsors oftentimes, they don't ask their attorney like, "Hey, I need you to give me the solution here," and they don't communicate that. And I think all the parties involved need to know. And one of the things we talk about here over at our firm here at Drossy is like, it's all about solutions. Where our clients are looking to us to provide solutions, not just tell them what they can't do. And so I definitely agree with that. I hope you're enjoying this episode so far. This episode is sponsored by PrivateLenderLink.com, where investors and brokers find direct private lending companies throughout the United States. Are you struggling to find the right lender for your deals? Private Lender Link offers a unique service to provide private lender recommendations. Over the past 10 years, they have established relationships with many reputable direct lenders and know each company's guidelines. Their platform makes the process to get recommendations very easy. Simply provide details about your loan request by filling out a short questionnaire. A Lender Link professional will review the information and invite a few select lenders to view your loan request. The lenders will reach out to you directly to further discuss the deal and provide a quote. Save yourself a lot of time and effort by leveraging Private Lender Link's knowledge, relationships, and 10 plus years in the industry. Their network includes lenders for commercial real estate, residential investment properties, and small businesses. To get started, visit PrivateLenderLink.com and click the big green button at the top. But during this whole time at the hedge fund and the investment bank, was it a kind of a combination of consumer facing mortgages and rental, or were you also doing the fix and flip and the construction and the bridge and all that at the same time?
No, so generally the business purpose single family rental space really came to life in 2015. You know that, right? So, the fix and flip, the bridge, the DSCR really started taking off at that time period. Shortly before that, you obviously had the larger, more commercial term portfolio loans, like the loans that, for example, Corvette are very well known for, right? Mm-hmm. So when you think about that, and that's how this business began to evolve, right? Into the single family, let's underwrite loans to rental cash flow space. What really brought about that opportunity, obviously, was the downturn in the market and being able to buy up a lot of distressed assets. Colony American Homes, for example, which was the initial business at Colony before they did Colony American Finance, which is now Corvette, really was a catalyst in some ways to seeing the opportunity to being able to lend, based on rental cash flow, because there was something to substantiate that rental cash flow could, in fact, be modeled and substantiated, right? Because they had become one of the largest landlords on the street. American Homes for Rent and some others are other great examples of that, right? So it allowed for the metamorphosis into a new business line. What was just an idea back then is now its own asset class, right? And that's private lending and single-family rental. And, that's a good thing. To answer your question, I've always been more diversified. So whether it was small balance commercial, agency, non-agency, et cetera, that was important. When I was at Deutsche Bank, we were the first ones to do, a Ginnie Mae reverse mortgage securitization, even though it had been, attempted by other investment banks, right? So I've been extremely lucky to be given the opportunity. And yeah, some of it's earned, but some of it is just building relationships in order to be dialed into an opportunity to be able to take part in a lot of those differentiated products, offerings, strategies, structures, from lending to asset management, liquidation, et cetera. But you had to have the moxie to put yourself out there, right? And, it's some of the things that I did early in my career are things that people would never dream of doing, right? And it was those particular, steps or putting yourself out there that really gave me the opportunity to become who I am today.
So I'd like to talk about, kind of then your exposure into the private lending arena. So was it during as it, when you were at Deutsche, was it after Deutsche? Was it, and then
no?
And then,
so I was actually the inaugural head of single asset lending for Colony American Finance. So I really got immersed into SFR at Colony itself.
So you were at Deutsche and then you moved over to Colony after that?
No, I was running the Windwater Jumbo Conduit, right? So we were a step out from a hedge fund. We were an issuer of RMBS securities, and we were really focused on jumbo non-agency mortgages. When I decided that I wanted to move on from that, and the business was not going to diversify into additional products, and the market really said it needed to, I decided that I was going to diversify, whether they were going to diversify or not. And I took a role with Colony American Finance. And that's really, the ask there was really to do the single asset lending and whatnot. They obviously already had a pre-existing term portfolio loan business and, and grow from there.
And let me ask you this. So that's your initial kind of, I guess, exposure into the market, into this market, early stages of the industry. Give me your reaction to it as someone who's been, kind of seeing a little bit of everything on the resi side and in some commercial side. Now you get into this weird fix and flip. It's a short-term loan. It's a flip. What is it? I don't understand. We get that a lot, right? From hearing stories of people who've been doing conventional or just consumer. Kind of tell us your reaction, how you approached it and how you attacked it.
So I obviously had historical HELOC experience, so the idea of an open-ended drawable loan was not odd. I also had experience in like 203K loans and things like that. So there are certain aspects of, the fix and flip and even the ground-up construction that are similar, but more flexible than some of those loan programs.
Right.
Also, historically, I worked on really large commercial, strip mall, high-rise financing, et cetera. So, it was really marrying, that real commercial business structure to residential lending because single-family rental DSCR is basically that. It's a resi loan wrapped to make it into a business purpose loan, generally facing an LLC, right?
Right.
We obviously could face other entities and have, borrowers, but really that is what the model is, right? How can we offer a product that's underwritten not only to somebody's personal income, but has the credence to be able to make a credit risk-based financing decision? And the answer there was rent, right? leases, rent, documentable cash flow, right? And that's really what we set out to do back then. But for me, it wasn't so far-fetched, right? Because of the fact that I had already handled open-ended products and also other UDA commercial, items on top of having that resi hybrid background. And I think, that definitely helped me. It didn't feel foreign to me.
Right. Were there any kind of like, oh, this is so refreshing because there's less red tape or anything like that? Because that's another reaction we get a lot in our
being
sector.
Somebody that's been in, somebody that's been in resi in a big way, you kind of sit back and go, really? I don't have to do that. I don't need to check 18, 19 more boxes and run, 25 additional compliance metrics. Honestly, it was a breath of fresh air for me, right?
Cool.
But I also, wanted to make sure that we were able to get to real values on these properties, because coming from a background of facing both primary residence, second home investment properties, I knew there was definitely a differentiator between how to value those assets and how those assets would depreciate from a care perspective over time, and care being more maintenance-driven items.
Yeah, and I like to talk about the diversification that Invigorate has come to market with, and I can definitely sense the continued parallel path that you want to achieve that level of diversification. What is your thought as to why, in the private lending industry, why more folks haven't adopted it in some way or shape or form? Because some people are just absolutely resistant to it, and some folks are open-minded, but then when they kind of discover they discover that, oh, it's not my cup of tea because of, I don't know, sometimes it's compliance, sometimes it's whatever. What are your thoughts as to why more folks don't do both?
Well, number one, doing resi is really expensive, right? Because of the extra compliance features, right? And, I think it also depends on what people's backgrounds are. A lot of the guys in the private lending space, and I know a lot of people try not to use this word, started out as hard money.
Yeah.
Right? Or they started out as brokers, right? And it's more of a natural transition out of hard money or being a broker to do business purpose lending than it is to go from being a hard money lender and a broker into facing, primary residence, emotionally attached housing, right? I think it's very, very different. The underwrites are also extremely different, right? The business purpose private lending loan is a lot easier to underwrite than a consumer-facing, let's call it 24-month bank statement non-QM asset with alternative docs, right?
Right.
So I also think it's your comfort level on the credit and the customer, right? In the private lending business, you're generally dealing with one customer type, and that's the investor. In a residential mortgage business, you're not dealing with one customer type. You could be dealing with an investor today. You could be dealing with, the mom with 3 kids tomorrow on her primary residence. You could be dealing with the higher net worth individual that likes to live in Manhattan but's got the East Hampton second home. It's a very different sell, a very different customer base, and a very different nuance. And then on top of it, regulatory compliance and underwriting deviation.
Right. I mean, as someone who does licensing work for clients, that's the biggest objection that I face, and then our compliance team, they always say that. And I always wonder, we had a client early on when the industry was very much a hard money lending industry, transition over to consumer, and they've done quite well for themselves, but it's always been kind of like top of my mind, like, there are companies that have the resources and skill sets and backgrounds for it, but yet they choose not to. And always, I think you hit the nail on the head from a business standpoint. Their avatar is different. It's dramatically different. Like, they've got to deal with, like you said, the moms and the actual primary homeowner. And then there's also the idea of optics. But it's interesting because on the flip side, we've seen a lot of folks join the industry coming from that space, right? They've transitioned over to here looking for opportunity. It feels like as the refi boom fizzled out. And I feel like you guys are in a kind of interesting position because they still have, as consumer products. So you guys are an interesting product service provider to work with them on both fronts. I like to ask you another question. You mentioned hard money as being kind of not like to talk about. I want to get your thoughts on that. Like when you were describing earlier, like 15 was the year kind of the industry took off or kind of became a thing. Like I like to hear more how you view the difference between hard money and private lending, because I'm agnostic on the terminology personally. So
look, I think so. So I think it's, who you've got sitting around the table is going to tell you a different view of the meanings of each of those, right? What I hear from a lot of guys in the market is, private lenders should not be compared to hard money lenders, payday lenders, et cetera. Well, private lending and hard money lending is not payday lending. It's like two totally different universes, right? So, for me, hard money generally is a guy that's willing to take a bet on giving somebody an extension of credit, but knows they may not get paid back, right? So they'll generally put 14, 16, 18% rates on it, right? So for the period of time where they are getting payments, and maybe the borrower pays the loan back in full, but they're taking on a differentiated risk, right? Private lending is really more what we'll call the single family rental asset class, right? And that is, more repeatable, underwritable, guidelined. It's not shoot in the dark, do I trust this guy underwriting, right? And I think that, that is a big differentiator. Now, do we make riskier loans on the private lending side than we do on the consumer facing mortgage loan side? Not necessarily. Right? Because you have to remember that the residential consumer facing mortgage, when they're calculating a debt to income ratio, is doing it to a gross dollar amount, gross monthly income. Well, I don't know about you, but the tax man takes a really nice piece of all the money that I make, right? So the question really is it riskier or not? And I think it depends on the product, the program, the guidelines, and the credit risk appetite in either asset class.
Okay. Yeah, it's been an interesting kind of nuanced topic in the private lending industry as of late, and it always left me scratching my head because I don't, as a former banker, like if you're not a bank, you're doing hard money. That's kind of how we viewed it. And when I came to this space, it was kind of very much the same. Like I had clients who were doing 50% LTV fix and flips, and I had clients who were doing 100% LTV fix and flips, but they were all considered kind of private lender / hard money. And depending on who you ask, exactly like you said, it's been interesting to see the evolution of that. It's almost become a 4-letter word in its own right. But it's kind of funny because when I go speak to my real estate clients, or I go to a Bigger Pockets meeting or something like that, they all call it hard money. So it's kind of funny how it's been received from our industry. And then there's a lens there, but then there's a lens on the borrower side, and there's a lens on the bank side. And it's kind of, it's a very interesting debate on a very simple concept, I guess you can call it.
Right. And I think a lot of it is really driven by what's your underwrite, right?
Yeah.
If you're doing the no doc underwrite, trust but verify, I like the guy, I meet him for lunch or whatnot, that's not private lending, right? And I think that there are differentiated nuances. I think if you're doing riskier collateral, look, on the resi side, there's guys doing 100+ LTV loans again. That's not the business I'm ever going to be in.
It exists.
But you know what? It's a differentiated risk type. But for example, you could say that's hard money. Right? Because where's your equity protection in a downside default scenario on those loans?
Right.
So I think I think you can make a case that there's also consumer-facing hard money and not just private lending hard money.
Right.
As well.
And a lot of people forget
really
about that.
Risk and profiling.
Right. And that was kind of the philosophy that one of our family office clients kind of extended to us. Like, I don't really care what you want to call it. It's underwriting, it's risk, it's asset valuation, it's borrower valuation. That's what we're doing. And you want to call it potato lending, I don't care. Right. He called it asset-based lending when he first got into it. Yeah, that's very good. Very, very cool. I like to kind of transition more into, the business and, where you guys have gone since foundation. You mentioned you joined forces with Fay, the national servicer, very well known in the space. and you've done both. And the private lending industry, you guys started. You said you came to the market in 2018, or was it 2020?
So Mortgage Venture Partners initially started in 2018.
Okay. And so in the space, we've had a lot of changes over the past. It's been about 4 years now since that year, and so talk about the initial entry into the market and how you guys have changed, or what's changed over the past 4 or 5 years now for the business.
Well, look, I think, when I first started Mortgage Venture Partners, I'll be candid. I started it with a forward flow to Wall Street, right? Then I used the track record from that to raise hedge fund strategy. We were then buying for our own book of business, right? Then we finished investing that fund in April of 2020, and I raised an equity round in a new fund, right? We were, the reason for the segue into Invigorate, candidly, was that, for your humor, the money on that capital raise was supposed to fund 3 days post the coronavirus lockdown in March of 2020.
Yeah.
And much like some of the large REITs and funds and whatnot, my capital got paused and I needed to get it back. So I decided that I wanted to see if we could get to more of a permanent operating capital structure instead of an equity capital raise structure. Pre that equity, I built the business funding it with my own money. I decided not to take strategic capital up front because I knew what I wanted to build. And sometimes your strategic partner is not going to let you build what you want to build because it's their capital that you're deploying. So I decided to spend my own money. But by the time I had gotten through that fund one scenario, in order to take the business to the next level, I really needed additional equity that I wasn't going to self-fund myself. So when the capital got paused, I had, the opportunity to go to run a large Wall Street trading desk and bring the entire strategy there. But I really wanted to continue to build what I was building because I really believe in the business versus the trade model, right? So Ed and I knew each other for a long time, saw the opportunity to work together. We launched a new co and brought the other platform under the umbrella. And really, relaunched the business from there.
So I'm hearing something that I really love to talk about is that, kind of committed capital, permanent capital, as opposed to strategic partnership, right? The carrot that has a big stick behind it. So now that after you established that with a new partner and you got a new co set up, talk about, I guess the change, because you guys were operating during COVID, right? My understanding was that you were, and you guys continued to onboard new partners during COVID. You guys are continuing to operate today. It sounds like that's what I heard, at least.
Yeah, no, we are absolutely in business and buying loans every day. Yep.
And that's part of the story that I want to highlight, because one of the most common threads that we've talked about on this show is the idea of that consistent. It may not be most comfortable, may not be the easiest, but it has that peace of mind factor to it when it comes to the capital that you have and you control, and it's committed, and you don't have to worry about it as much. And so 2020, let's talk about 2020, because you guys were able to beat a lot of your competitors who froze and continue to operate. What allowed you to maintain that and then scale from there? Because that was a little bit before that when you guys kind of launched.
Truly having a non-trade strategy, right? We were able to very quickly adjust our product offering to react to the market, and then enter into discussions to do more diversified strategies, right? And not everybody is that lucky, right? Sometimes they're beholden or whatnot. Yes. Does it take skill? Absolutely. Does it take relationships? Finitely, yes, right? But at the end of the day, you have to be able to know how to pivot quickly, right? And that is, a skill that I think, really drives, why certain people are at Invigorate, why I've partnered with certain people on our business, et cetera. It's being able to be nimble, proactive, not reactive, to keep the business model going, but not have to shut down the business. right?
So
And I think
talk about that
that's
real quick.
super
So
important.
talk about that. So what kind of changes did you make? What kind of pivots did you make? 'Cause I'd like to hear about that a little more because COVID and right
Well, I
now
mean, guys,
also
you got to think about it, right? So the non-QM, so my initial fund at Mortgage Venture Partners was non-QM, QM irrelevant, and business purpose strategies, right? Non-QM was never tested. COVID definitely tested it, right? We all sat there and saw $105 price loans become 88 cents overnight,
right.
The value devalued really quickly, but then when they saw there wasn't a run on Washington on default, we also brought the business back up very quickly, right? We didn't take 10 years like during the housing crisis in order to see a correction on product coming back, right?
Right.
So I think that that's important. I think COVID in a lot of ways is a good litmus test, right? Things that can go sideways that really have nothing to do with market fundamentals, okay? No, the market fundamentals weren't bad, and overnight we had product types devalue.
Right.
Okay. Why? Government reactivity, for example, driving interest rates significantly lower to make sure that there was still access to credit. Concerns from investors that, they really didn't know away from the housing crisis performance, what could happen from a default perspective, and people comparing non-QM to subprime, which it absolutely is not, right? So I think that that's extremely important as well. For us, it was, having the relationships to be nimble enough to still keep the business going, but then also the capability to slow down certain products to then speed them back up, right? And I think that's important. I'll be candid. I did that again recently in the rising rate environments because I've seen this rodeo before. I've lived through many cycles of the industry, and I knew what to expect, right? I had a prediction in my mind, and I said, okay, this is the risk I'm willing to take. This is the risk I'm not. And I waited to, gas pedal certain additional things on our platform until I felt that rates had run up enough to be stabilizing, right? So I think that's important. The other thing at Invigorate is I have diversified rate type products. We've always had the ARM products, the fixed rate products, but I also have floating rate, right? So where a lot of guys only did 30-year fixed, we've had diversified products available the whole time.
Interesting. So let's talk about that. So the current climate is, it's an interesting time, I guess you can call it. I'm not as dramatically talking about it as COVID, as we were during COVID. I think COVID was its own weird situation. This is a lot more one of those things that people should have saw coming. You saw it coming. I saw it coming. My partner saw it coming. But for some strange reason, there seems to be a very similar reaction to what had happened back in March of 2020, in the sense that the industry is losing a lot of its capital solutions. Secondary is tightening up, and a lot of our originator clients are kind of scratching their heads as to now what's going on now. We're seeing some slowdown in general. I'd like to get your thoughts on that. Where you think we're going to be headed, and how Invigorate is going to weather the storm, or actually take the opportunity.
Look, let's be candid. Originating loans, let's say in the agency locked up world, has just been super easy. Okay. The government during COVID brought rate levels down to historic lows. Literally, in December of 2020, we're at a 2.68% rate.
Oh, I know. Yeah.
Right.
Yeah. I refinanced the second it hit 2.5.
Had a 5% loan. What borrower that had a 3%, 4%, or 5% loan wasn't running on Washington to voluntarily refi? Right. Yep. It was really simple to capture the client because you were, selling rate. Right.
Exactly.
The market has to shift to selling payments. Okay. And differentiated strategies need to come back. And that means not only being a 30-year fixed world, it also means not only being a 5, a 7, or a 10-1 ARM world. Why? The payment shock after the 5, the 7, or the 10 is going to be significant for these borrowers. The question is that the right answer from a possible default trigger perspective? Right? Or would doing something more floating rate make better sense? So the borrower, feels the ebb and the flow of the market. And if we are in a world where rates are going to continue to increase, gets to grow up into that larger payment, for example, versus, having a 5-year fixed and all of a sudden their payment's 4 times the amount, right? On a max rate life cap, right? And I think that that's an important question that the industry needs to consider and react to. I also think that right now, the securitization market is locked up in some ways because investors have been in a place where it was easy to buy bonds historically. Mm-hmm. Again, low interest rate, lots of production, competitive pricing, yada, yada, yada. Mm-hmm. We're going back into the real world, guys, of lending, okay? The 90s, the 2000s, where you actually have to put more effort into that customer acquisition, right? It's not just as easy as saying, hey, I got a 2% teaser rate for you, right? And I think that that's really what you're seeing, certain companies, going out of business, certain market entrants, certain market exits or pauses or ebbs and flows. It's really, who's been in this business long enough to understand what they have to do to really deal with the market environment we're in. Like the last time that, the Fed raised interest rates 75 basis points in one day was 1996. We're in 2022. Mm-hmm. I was in the business in 1996. So I remember, but not a lot of people were, right? Right. So you're seeing some, what I consider to be overreacting right now. Mm-hmm. And I think you are going to see some equalization, and some of the guys that have pulled out are going to be back in, as an example.
When they get more comfortable but back with the current new normal. Yep.
Yeah, but what they're going to do is watch the people that have done this before, and they're going to try and clone it, right? But in that process, they're going to miss opportunity.
It's a good way to put it. Yeah, I mean, it's kind of funny because I always, there's a client, we call him Uncle Chuck. He always jokes he's been making loans since Abraham Lincoln freed fought the Civil War, and he's been doing it for 40 years. And I always talk to him about this because he's been doing it for so long, and he said the same thing. That I know exactly what to do, exactly when these crises hit. It's always the same, and you gotta stick to your guns. But you do that, you'll survive, and you'll be able to to win while everyone else is kind of put their head in the sand. So that's the good way. It's kind of the same, echoing the same story. And what's funny about that is that we had a very similar situation not 2 years ago, but for some strange reason, I mean, we always joke about how people have short memories, but man, these memories really are short, because these solutions could have been solved for, I think, a lot earlier, at least for some of our people. Not even like the secondary, but at least the originators and clients, diversifying their philosophy and strategy and the mandate could have been easily prepared for. It was 2 years to do it, and a lot of folks just took advantage of the opportunity in front of them, didn't think the long way. When it comes to that, we're seeing a lot of talk about people worrying about these rates getting to, I guess you call it 1970s numbers, right? 10, 12%. I'm not asking for a crystal ball, but rationally within the next year or so, what do you think? I don't think we're going to get there, but I'd like to hear what you think about it.
Yeah, I mean, look, back in the throwback day, right, when you were able to charge 19% interest rates, that was a very different era, right? Like when my parents took out their first loan, I think they had an 18% rate. I think people are forgetting that there are usury caps in place from a regulatory perspective.
Laws have changed.
Right? Laws have changed. Regulation has changed significantly. What you're allowed to do as a lender is very different. There's a lot more red tape, right? Crystal ball, no, I don't believe we're going to be in, on the consumer-facing side, we're not going to be in the 14% rate level anytime soon. Do I think that there are some people on the private lending side who are trying to sell that we're entering another 2008 financial crisis so that they can charge, mid-teens interest rates now? Yes. Do I think that's the right thing to do? No.
That's a good way to put it. Yeah, that is happening. And I don't agree with that either. And I think that we're
Yeah, I mean, I sat in on a conversation where, you know, a high-level executive literally said the market fundamentals right now are identical to right before the 2008 housing crisis. I almost fell off my chair. It's like, no, they're not even close.
Right. Well, I think it's, like I said, overreaction, general freak out. But we had this debate in the office too, like, where do you see rates climbing? And I was like, man, I mean, probably 8. As far as it's going to go is 8. I don't know. I mean, I think 8, at least 8.5. I remember my student loans were around 8.5, and mortgages were around there.
So if I had to bet, and I know this is going to get played back to me a year from now, right? But yeah, you'll probably be the one to send it to me. But I actually think after the Fed at the end of the month raises rates again, right, you're going to start to see things even out a little bit more, and then you're going to see small rate increases over the course of the next year.
Right.
But you're not going to see these, 3-point rate increases over again.
I mean, mortgage rates
I do not
steadied out even after the recent rate hike. They kind of steadied out a little bit. They climbed and kind of declined a little bit. So I agree with you. We're not going to see a dramatic climb. All right. Well, I mean, enough doom and gloom.
For me, though, I'm sorry, Kevin.
No, go ahead.
Listen, the one thing is I'm also a data junkie, okay? So I look at all of the details, right? And if you really look at what drives inflation with the CPI index and what the Fed is reacting to, and you tease out the core features, right? The biggest issues you're seeing are huge climbs in energy, gas, diesel, et cetera, and food costs. And I think people don't really remember that in order to get food, you need gas, diesel, DEF, et cetera, right? How does everything get into a grocery store? So, my biggest thing is if you get energy under control, right, you actually will start to even out your inflation numbers, and you'll stop seeing these doublings or 1/3, increases that you're seeing right now. And a lot of people don't pay attention to the fact that, home prices are not part of the CPI index. They took them out in the 80s.
Yeah.
Right?
Yeah.
So, you're correlating, making reactions on interest rates to something that's not even necessarily fully inclusive on data to react to, right?
Right.
But they're doing a cost of funds perspective. It's not only mortgage, right? And I think we need to keep that in mind also.
Right. I agree with that. I think that a lot of people forget about that. Real estate market numbers are still on the rise. We haven't seen a significant dip yet, and I think we've had this conversation on the show a lot about inventory, and there's a lot of counterbalancing components that don't put us in a doom and gloom scenario. And I like to kind of stop the doom and gloom and kind of transition out anyway. But one of the things that we like to do on the show as we kind of pare down for time, we're almost out of time. I'd like to ask some rapid fire questions to you to get to know you a little more. And they're really random ones. And so the first one I want to ask you was, if you weren't where you currently are career-wise, what do you think you'd be doing instead?
I would own a bakery.
Really?
Really?
Are you a baker?
I actually went to professional baking classes on the weekends.
Oh, really?
One of the things that I love to do is I actually like to bake and decorate cakes. I do my son's birthday cake every year, for example.
Oh, that's awesome.
I would own a little coffee shop bakery and be left alone.
Oh, that's wonderful. I love that. That's very cool. All right. Next question. What is one business tool that you cannot live without?
You're going to laugh. Paper. Okay? I am still somebody, believe it or not, that likes to plat things out with a pen, right? I can model like the best of them. I was once a structurer. I can code. I can do all that crap, right? But there is something to be said about being able to quick and dirty figure something out or sketch it out,
right,
and be able to then react to it and refine it from there before you're working in, decks or PowerPoints or Lucid or whatever else there is.
Is it a yellow legal pad? Is it a notepad? Is it one One of those moleskins.
It's usually more like a 5-star spiral-bound notebook.
Oh, the college ruled. Very cool.
It's wide ruled only, Kevin. Wide
ruled only? All right. I get behind that. I haven't seen one of those in forever.
But I would say it's paper and modeling. Paper, modeling, and data. That's the answer.
Love it. All right. So last one is, if you're not out there, dominating the lending world, what do you do for fun? I think you kind of hinted at it on the cake side, but what do you do for fun?
So I really like to be outdoors.
Okay.
So my family and I have a lot of toys. We have 4-wheelers, and we have razors, and
go
cool. Off-roading and into the mountains. We like to go hiking. We like to go biking. So
nice.
Boating, so we've got a lot of, toys to play with.
Nice. Any of the ATVs as well?
Yeah. So I personally have a Polaris 4-wheeler 850.
Wow.
My significant other has one too. My son has a 570. So, we've got the single ride-on, and then we have a 4-seat Polaris Pro XP, which is a razor.
Nice. So, very nice.
Yep.
Those are cool.
And a speedboat.
Oh, what? Wow. Very cool. Very cool. Awesome. Well, that's great. This is the part of the show that I love, to learn more about the person on the show. And I love it when we hear about these, like the baking thing. I love to bake myself. I'm on the bread side, but I love to hear these kind of things, because we spend so much time talking about interest rates and LTVs and real estate, but people are where this business really shines. And so thank you very much for sharing those little tidbits of information. I think that's about all the time we have for the show. This is being recorded in July. I think we're going to put this out later in the summer, but really appreciate it, Jen, for joining us here on Lender Lounge. For our listeners, if you haven't already checked out Invigorate Finance, please check them out. They're going to be at our upcoming events, and also go check out their website as well. Jen, once again, thank you very much for joining us.
Thanks, Kevin. Appreciate the opportunity. I really enjoyed the discussion. Have a great day.
All right. Thank you very much. Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.